This is the Asia Trade. I'm Annabelle Droulers in Sydney.
I'm Avril Hong in Singapore. Your top stories this hour. A cautious open ahead for Asian markets, even as stock bulls drive the S&P 500 to its longest monthly winning streak since 2018. The yen gains as Finance Minister Satsuki Katayama tells Bloomberg exclusively that Japan has a free hand to act against speculative currency moves. And China Vanke averts default, the debt-ridden builder winning creditor support to extend a bond repayment grace period. But first, take a look at how U.S. assets fared overnight. We saw stocks climbing, and it's worth noting that against the backdrop of all this, VIX, actually volatility came down. You're seeing that slide there. So maybe traders don't want to pay for protection over the holiday period, and that tells us something about maybe where they think the market is heading. We are also seeing in terms of the U.S. 10-year and how it's still hovering around the 417 level, but you have Treasury options expecting the 4% handle within weeks. So again, a matter of positioning within markets and across assets, they seem to be aligned in terms of the expectations of lower cuts or lower rates from the Federal Reserve. We are also seeing geopolitical premium being built back in a little to U.S. crude futures or WTI. Gold is rallying as well. The key question into next year, I guess, is firstly whether we see that Santa rally and whether there's going to be enough momentum from that into 2026 and how much tech is going to be contributing to this. The Bank of America chief, Brian Moynihan, had something to say. Take a listen.
We feel constructive for next year. We think AI spending continues. We think there's benefits to the American taxpayer from tax rebates, lower taxes due to the tax bill going through and being effective for next year. And we think the expensing and other bonuses for businesses are good. So all that leads to our confidence that we go from basically a 2% type of growth level this year, plus or minus up to 2.4%, which is all due to that. And AI is kicking in more and more. And so it's not all attributable to AI, but that's having a marginal impact that's pretty strong.
Yeah, great interview there, and we're going to get more insights from that just in the hours ahead. But essentially, tech has still been the dominant theme that we've seen in equity markets, and that rally that we're setting up, as you were saying, Avril, a Santa Claus rally now becoming feasible for the year end. What else we're tracking in the session so far today is, yes, you can see here across the board, we are expecting equities to move higher. We're also continuing to watch the moves that we're seeing in the Japanese yen, also what we have in Japanese government bond yields as well, because yields have been rising across the curve, hitting levels that we haven't seen going back to the late 90s, so just ahead of the dot-com bubble burst. But the yen weakness as well, that could be something maybe that provides some upward support for Japanese equities, given that you are again seeing those Nikkei futures pointing to some modest gains there. But on that point as well, there has been a warning issued by Japan's finance minister on currency speculators or against currency speculators, telling them essentially that they've got a free hand to take action. The Japanese finance minister Satsuki Katayama spoke to us exclusively in Tokyo.
まあ為替の状況っていうのは必ずしも
Foreign exchange markets don't move only on interest rates or rate differentials. Especially toward the end of the year, around Christmas, trading tends to get thin, and many factors can drive the yen's moves. But the yen's sharp, very short-term movement right as the BOJ governor began his press conference last Friday, that was clearly not in line with fundamentals, but rather speculative. Against such moves, we have made clear that we will take bold action, as stated in the Japan-U.S. finance minister's joint statement.
Now that the Bank of Japan has moved to raise interest rates, the next focus is clearly on whether the government will step in with foreign exchange intervention. How do you see it?
We have
an agreement with the United States that allows us to intervene whenever the yen makes an excessive move. That means we have a free hand.
In the past, a finance official has called a 10 yen move in a little more than a month excessive. So what kind of time frame and magnitude would you consider a sharp or disorderly move? Is there any benchmark you use to assess that?
I can't say definitively whether there's a benchmark or not. I worked closely with currency chiefs during my 20 years at the finance ministry, and I've stayed in close touch with many of those who came after I left. Each situation is different, so it would be wrong to expect the same pattern every time.
Trading tends to thin out around the year-end and New Year period. Is it fair to say that the authorities are fully prepared to respond?
We're always ready to act. That goes without saying.
When it comes to a question of a certain degree of fiscal discipline, there are various ways to interpret that. For example, how much the government relies on bond issuance or how much JGBs it'll issue. Could you share a bit more on how you're thinking about these points?
I
can't give you specific numbers, but even after the supplementary budget was passed, we made it clear that the total amount of government bond issuance, which, after all, is what puts pressure on the market, did not increase. At this time, we're talking about the initial budget for fiscal year 2026. We're confident that it won't be something that places an undue burden on the market either.
There are concerns in the market that Japan's fiscal position may be deteriorating. What message would you like to send in response to those concerns?
By switching to active fiscal policy, we knew before we started that in the first fiscal year, some of the finance numbers would deteriorate. But that isn't the problem. We've spent 10, 20, even 30 years in a situation where economic growth barely picked up no matter what we did. There's no point in just doing the same things as before. We need to make a decisive shift, to concentrate resources and boost our growth potential. I believe we'll see a strong pickup in investment next year. And if you look at projected tax revenues for next year and the year after, I think what looks like fiscal deterioration now will prove to be only temporary.
Japanese Finance Minister Satsuki Katayama speaking exclusively with Bloomberg's Takashi Umekawa in Tokyo. Let's get to the market reaction with Bloomberg M Live strategist Mark Cranfield. Hey, Mark, good morning. We've just heard from the Japanese finance chief Katayama. How much trouble might the yen be in 2026? Is this verbal intervention going to be enough?
Yeah, good morning. Probably need to do quite a bit more work to really turn the yen around. It's good to hear. I mean, traders will certainly take on board the fact that Katayama has said that Japan has a free hand to get on with intervention if needed, which of course they've done before, although it's been quite a while since they last intervened in the markets, more than a year since they did that. The key thing from a trader's point of view is that once again, Japan is going to be on its own. The most effective forms of currency intervention in the market happen when there is more than one central bank involved. So if the Bank of Japan is given instructions to buy the yen in the market, traders would be a lot more wary if the Federal Reserve was in there or the European Central Bank at the same time. Coordinated intervention often works to change the direction of a currency. When it's a solo central bank, it is not as effective. And as we've seen, the last time that Japan went in full guns blazing into the market, there was also a Bank of Japan interest rate hike around the same time. So you had currency intervention and a rate hike together. That was a pretty big signal to the market. But of course, it went slightly wrong because there was a big spillover, massive risk aversion. Japanese equities came down hard and it spilled over into the global markets as well. And since then, Japanese authorities have been pretty wary about how they go into the market. And we're almost back to where we were when those intervention levels were done. So whatever happens here, currency traders know that, yes, we're getting closer to a point where the Japanese authorities want to do something. But whatever they do is really going to be a limited use. It will have an effect probably for a few days, but they can't really change the direction of the yen until the Bank of Japan gets serious about interest rate hikes, not only taking short-term rates to a neutral level, but really going to the top end of that neutral range, which probably in Japan's terms means something like 1.5% short-term interest rates. There doesn't appear to be any desire to get on with that quickly. In fact, rates traders are pricing for the next Bank of Japan interest rate hike around September next year. That's a long way off. If you're a foreign currency trader and you're being told that the next rate hike isn't going to be until 9 months or so later, that isn't really a threat for you to be shorting the yen. As you can see, it's not just against the US dollar, it's against multiple currencies. Across the G10 space, the yen is being used as a currency tool to go for higher yielding currencies. Even after raising rates to 0.75, the yen is still a low interest rate currency. So yes, traders will be expecting work, but it's a very big job for Japan to turn it around.
Yeah, and to your point, I mean, we've sort of seen this intervention or verbal jawboning being really short-lived in the past, but again, I mean, the neutral rate, we didn't really get much of a sense from Wader in that presser exactly where he sees it. But at the same time, we have seen traders still pushing aggressively, at least in the bond space, for more hikes to come. That spillover effect that you're seeing to US, UK, German yields that have also been lifted just a fraction, do you see that being sustained at all?
It's a significant problem for the Japanese interest rate market, from the point of view that traders can see a couple of things going on. Number one, Japanese inflation is sticky around the 3% level, and yet you've got short-term rates below 1%. So clearly that negative yield implication is going to be there for some time. Japan, even if they raised interest rates to what they think is neutral, they're still short of the inflation level unless it suddenly comes down. Then when you're a big country like Japan, you don't work in isolation. You're part of G10. And you've got European yields moving up pretty quickly, especially at the very long end of the yield curve. German and French yields have been racing up pretty hard. Europe's going to be spending more money on defense. It also has big deficits. That's not a good cocktail for long-term investors in fixed income products. So that is a global impact which Japan will also be caught up in, and it's happening already. Even Treasury yields are starting to push up at the long end. They're not as high as they were in the middle of this year, but they're edging that way. If we get back to 5% yields on 30-year treasuries, that will impact the whole G10 complex. It's not a great situation unless Japan acts more aggressively on its own. As long as it's part of the G10 and it's looking across there, it's a similar story where global yields are going up, curves are getting steeper, and the yen is just part of the whole game. Until Japan really gets serious about raising its own interest rates to a level that really supports the currency.
So the risk of higher yields is there. At the same time, Treasury options, they're pricing 4%, not so far away from now. But we also have maybe the stars aligning for the Santa rally, and then you think about the Fed rate cut, continued expectations of that. Along with that, volatility has been coming back down. What is the setup for U.S. assets into next year?
Part of the reason why volatility, the VIX in particular, is coming down is because people don't really see a major threat to the good mood which is going on in markets. We got through, last week was full of central bank meetings. We've got through that pretty well. There was no major fallout from that. So now people can just look ahead to the early part of next year, and the calendar is relatively clear. Equities are in a good space. The AI story is still very strong. We're still hearing very positive things about that. People are also looking forward to potential big IPOs. OpenAI or SpaceX could be the next ones. Could be huge. Some of the biggest IPOs ever seen in financial markets. People are very excited about that. That's helping to increase the valuations across the tech space as well. There's lots of positive things on the near-term outlook which are keeping people involved and keeping him going for this Santa rally. It can probably extend. Don't forget, the next Fed meeting is not until later in January as well. And there's still hopes that there could be lower interest rates there as well. When the new Fed chairman is named, he's probably going to be somebody in favor of supporting lower interest rates in America. So all of the things are coming into play. The one thing that would suddenly disrupt it would be a dramatic change, for example, in the currency space with the yen getting strong very quickly, or a huge collapse in the commodity. We're seeing precious metals going through the roof. Silver, platinum, gold, all setting records. So only a sudden change in sentiment in that kind of space would turn the markets around. Volatility would increase. For the moment, people don't seem to think it's going to happen in the near term.
Mark, always good to get context from you. Looks like we might see Santa coming to town. Bloomberg M Life strategist Mark Cranfield for us on the Asia trade. We have more ahead on the program. This is Bloomberg.
Commander-in-Chief, it's my great honor to announce that I have approved a plan for the Navy to begin the construction of two brand new, very large, largest we've ever built, battleships. You know, you used to build the Iowa, the Missouri, the Wisconsin, the Alabama, many others. We had big battleships. These are bigger.
President Trump speaking at the White House a little earlier, announcing a new Golden Fleet for the U.S. Navy. Let's bring in Bloomberg senior editor John Harney. So, John, you're hearing from the Commander-in-Chief announcing this new Golden Fleet. What does this entail, and what is spurring this move?
What's spurring it is that the United States has fallen far behind China in shipbuilding. And President Trump, as a candidate in last year's election, highlighted the necessity of bolstering the American shipbuilding industry, both for national security and as well as commercial purposes. Now, these ships would, of course, be built in the United States, and as part of this defense, a renewed attention to defense and to heighten America's defense posture as in its rivalry with China, and also in its efforts, in its aggressive efforts in Latin America right now.
Yeah, let's talk about that, Venezuela as well, because we've got a story out this morning looking at those sanctioned tankers that appear to still be managing to circumvent the blockade. What's the latest on that front?
Well, first of all, President Trump just now at Mar-a-Lago, he may be on vacation, but the aggressive rhetoric regarding Venezuela continues from Florida. Earlier today, his Homeland Security Secretary, Kristi Noem, told Fox News that the destruction of boats that the American authorities say are trafficking narcotics and the seizure of oil tankers are part of a campaign to convince President Nicolas Maduro of Venezuela that he should either step down or somehow leave power. And just now, moments ago, President Trump pointed out that America now has one of the largest armadas it's perhaps ever had in South America, and that if Mr. Maduro tries to act tough, I'm paraphrasing a bit here, if he tries to act tough, it'd be the last time he acts tough.
That was our senior editor, John Harney, there. Thanks very much for your time this morning. And let's also shift to some other global headlines that we're tracking. Russia's liquefied natural gas exports to China surged to a record in November. That's as buyers shrugged off the risk of Western sanctions. Deliveries more than doubled from a year earlier to 1.6 million metric tons. That means Russia is now China's second biggest LNG supplier after Qatar. A senior Russian general has been killed after a bomb exploded in his car in Moscow. Vanil Savrovov was in charge of the operational training department in the Russian general staff. Investigators have opened a murder inquiry and are looking into Ukrainian involvement as a possible theory. Cambodia and Thailand have agreed to meet on Wednesday to discuss conditions for a ceasefire. The decision comes after foreign ministers from Southeast Asian nations met in Kuala Lumpur. At least 40 people have been killed and 500,000 displaced. That's since hostilities resumed this month and ended a July truce that halted an earlier round of fighting. We'll have more ahead on the Asia trade. This is Bloomberg. We've got some headlines just crossing the terminal in the last few moments relating to the amended offer from Paramount to acquire Warner Brothers. And Warner Brothers is saying that it has received this amended offer from the company. They're saying they're going to carefully review and consider it, but they're not modifying ultimately their recommendation for a Netflix merger. So let's bring in Chris Palmieri, who leads our media and entertainment coverage. And Chris, we were just talking there in the ad break, and you were saying this sort of reaction from Warner Brothers isn't too surprising, but why is that the case for you?
Well, it's very similar to the statement they put out on December 8th when Paramount made its hostile offer for Warner Brothers. The board said, thank you, and we'll consider it, and then later came out with this sort of strong rebuke of the Paramount offer. So the news today certainly was that Paramount is addressing a lot of the concerns that the Warner Brothers board made about their bid. They've got that full backstop of the $40 billion in equity from Larry Ellison. They've made changes to the requirements. They were asking the company not to be able to do some things in the interim period before Warner Brothers was acquired. They've increased the breakup fee they would have to pay if their deal doesn't go through. So those were all things that were pointed out as Warner Brothers as issues. And now it's back to the Warner Brothers board to review the new terms.
Chris, talk to us about how this is Larry Ellison putting part of his personal fortunes behind this bid. What does this tell us about the determination by the Paramount bid?
Well, there was a little bit of talk in Hollywood, if you will, that, how strong is Larry for this? How much money is he going to give his son, David Ellison, who's the chairman and CEO of Paramount? He'd already just put in some $8 billion or so to acquire control of Paramount. But this statement today is definitely a resounding yes, he's all in.
So then, I mean, you're saying we can expect maybe a further readout from Warner Brothers, exactly why they are sticking with that position on Netflix, being the preferred buyer still. But what else can Warner Brothers do then to sweeten the deal, given the sort of guarantees that Paramount was making was one of the key sticking points or hurdles?
There were other issues that the board had pointed out. They were concerned about the debt level that Paramount was going to have. They were concerned about the level of job cuts in that. Paramount was promising $9 billion in cost savings. And then there's just the price, which Warner Brothers had said is inadequate. Paramount hasn't increased its price. If Warner Brothers did dump the deal with Netflix and move to somebody else, they would have to pay Netflix $2.8 billion. So that breakup fee isn't being addressed in the new Paramount offer. So there's quite a lot of speculation and anticipation that Paramount increases its offer.
And Chris, what will you be watching next as this saga continues unfolding?
Well, we're just keeping working all our sources, trying to figure out what Warner Brothers' next step is, what Paramount's next step is, and if Netflix responds with some even higher bid.
Yeah, something that could be stretching on into the early parts of 2026 for us to watch. Chris, thank you. Chris Palmieri, who leads our media and entertainment coverage. We have more ahead on the Asia trade. This is Bloomberg.
Taking a look at Japanese assets this morning, because we have seen actual further yen weakness, trading back down to that 157 level, but certainly something that's been playing in as well to the bond space, because you've seen yields that have been rising across the curve, and equities actually setting up for a fairly flat open. You can see Nikkei futures, that contract just coming online today in Singapore, but certainly a lot of our attention has been on an exclusive interview that we had with the Japanese finance minister, talking about really the power that government officials have to intervene in currency markets. So a little bit more jaw-boning, rather, from the finance minister, Satsuki Katayama. But take a listen to what she said.
今回日銀総裁がその記者会見した3時
The yen's sharp, very short-term movement right as the BOJ governor began his press conference last Friday. That was clearly not in line with fundamentals, but rather speculative. Against such moves, we have made clear that we will take bold action, as stated in the Japan-U.S. Finance Minister's joint statement. We have an agreement with the United States that allows us to intervene whenever the yen makes an excessive move. That means we have a free hand.
For more, we're joined by Sayuri Shirai, Professor of Economics at Keio University this morning. And Sayuri, thanks very much for your time. We can start, I think, with that interview we had. It was a Bloomberg exclusive with the finance minister in Japan, talking about really the flexibility that they have to intervene in FX markets. The question is, though, any sort of jawboning we get from government officials has had the tendency to be quite short-lived.
Yeah, so they can intervene in the foreign exchange market, that's possible. But at this moment, the main reason why yen has been so weak since 2022 is because of the big interest differential, especially in real term. So Japan's policy rate in real term is minus 2%. So it's very difficult to increase this interest rate because Japan's inflation is around 3% cost push inflation, and policy rate is just 0.75%. So very low real interest rate. So it's very difficult to change this trend at this stage.
Yeah, exactly, especially when you've got the BOJ that's really not moving in lockstep with other global central banks. I mean, it's very difficult to arrest those moves. What then do you think is the outlook for the currency, and as well, what is the priority that government officials are likely to place on that weakness?
So, government is changing their strategy. Over the past years, Prime Minister Takaichi was always criticizing Bank of Japan's raising, interest rate increase policy. But I guess since, October, yen started to depreciate even more. So they know this is really creating cost-push inflation. So maybe they are compromises to some extent. But the Japanese economy is so weak. So that's why Governor Ueda cannot be so confident about raising interest rates. So this is a dilemma. So next year, it also depends on what will happen to U.S. policy. If U.S. shows very determined path toward lowering interest rate, that might change this exchange rate towards somewhat more appreciated level. But still, I think yen will remain at a very depreciated level next year.
Sayuri-san, on the issue of U.S. policy, when it comes to, I guess, the signals of intervention, how on board would you say the U.S. Treasury is with it? Is there a tacit understanding between the U.S. and Japan on this?
So U.S. Treasury, I think they will accept it because Japan is trying to appreciate exchange rate, not depreciating, creating competitiveness. So, it's a different story. And I think also, U.S. Treasury is always say Japan is behind the curve, Bank of Japan is behind the curve. So maybe it may suggest more policy rate increase by Bank of Japan.
What would you say is the sort of yardstick? I mean, the BOJ has been reiterating that there's no specific level, or finance authorities in Japan, I should say, are highlighting there's no specific level. But what is your sense of how we can tell the levels in which they might step in?
Yeah, so 160 is very dangerous level, and that is a time that, Treasury intervene. So, we have to check. But still, even now, it's very depreciated level. So we are, this is really creating a very bad cost push inflation. This is the biggest problem. So I think people are worried that yen stay at very, high depreciated level, or maybe even depreciate further if the Takaichi is going to do more fiscal expansionary policy in 2026. So 160 is, I think, quite a dangerous point.
On fiscal policy, how aggressive are you expecting the extra budget, the forthcoming budget, to be from the Takaichi administration?
I want to say two things. Takaichi-san is trying to show that she's a very bold, expansionary, doing fiscal policy. And so recently, she showed some tax cut by expanding, income tax deduction. But to be honest, in Japan, people are paying more and more social security, premium and payments. So that is really a lot. And also a lot of people are still paying sort of de facto inflation tax, right? Because we have a bracket clip. So considering all this de facto inflation and social security spending, I think the net tax cut is very small. So I think people do not feel that their lives are getting better. Also, her policy is really trying not to directly influence the food prices. Food prices have increased over 28% in these 4 years. Energy is just 13%, but she never really tried to deal with, reducing, say, food consumption tax, for a while, and she tried to avoid it. So, even she tried to do a lot of things, but she's tried to, allocate a lot of money to local government, discretionary spending. So she doesn't really touch on these extremely high food prices.
Yeah, and of course that's such a big component of inflation, or the inflationary basket. What do you think then about the outlook for next year? Because when you've got the government officials rather in Takaichi's government that's very focused on more of an expansionary policy, and that goes up against the BOJ that's looking to hike, and you've seen that agitation in bond markets as well, really with yields rising across the curve, and that limited spillover so far, but spillover into US, UK, German bond yields. What sort of risks are you monitoring then in global bond markets?
Yeah, so 10-year yield is now reaching 2%. Still relatively low, say, compared to 30 years ago when the policy rate was at a similar level. 30 years ago, 10-year yield was, around 4% or 3%, so much higher, right? So, I think long-term yield is still low, mainly because BOJ still hold nearly 50% of long-term government bond. So, of course, there is a tension here. I'm pretty sure Prime Minister is trying to show another expansionary fiscal policy, but probably limited impact for the increasing disposable income in next year. But there is a tension here. So, I think it's very difficult, especially for the BOJ monetary policy.
Sayuri, always great to get your insights. Thank you so much for your time with us on the program today. Sayuri Shirai is Professor of Economics at Keio University. Now let's take a look at how U.S. assets are faring as well. Of course, overnight we saw that bounce in stocks. The dollar resumed its slide, partially to do with a bit of this verbal intervention and the other side of the dollar-yen trade and the yen appreciation seeping in just a little bit. We are, of course, looking at 10-year bond futures in the U.S., a bit of a pickup. That expectation in Treasury options is that we could see 4% within a matter of weeks on the 10-year yield. So you're still seeing that continued bet of Fed rate cut expectations. Fed Governor Stephen Miran says the central bank risks sparking a recession unless it continues lowering interest rates next year. He also told Bloomberg that data on housing costs was impacted by the government shutdown.
It is true that the shelter stuff was somewhat distorted by some of the quirks of recovering from the shutdown. But it's also true that the shelter data were distorted for most of the year because of really long lags with which shelter inflation is calculated. If you look at market rents, they've been running at about a 1% rate for about 2 years now, right? That's not indicative of any price pressures in housing whatsoever, but it takes a really long time for measured shelter inflation to catch up to that just because of various quirks of the statistical measurement process that I got into in my speech last week. So I do think there was maybe some downward bias in last week's print, but at the same time, there's been tons of upward bias in data for the entire year, and it's inappropriate to say, okay, well, we have to adjust for the downward bias, but we're going to accept the upward bias. That itself is a deeply biased position. We got to be clear-eyed about both.
Well, do you feel like, and yourself included, but do you feel like members of the Fed are cherry-picking what about inflation they like or dislike?
Well, I mean, I think that for the last few months, we've had data come out in accordance with, I think, my view of the world. The inflation data have steadily come in cooler than expectations. The unemployment rate has poked up, potentially above where people thought it was going to go. And so we've had data that should push people into a dovish direction. And I think it's somewhat problematic if you see those data coming out and you don't adjust your policy prescriptions in a dovish direction. What does that say about the reactiveness of policy to the economy? I think it reflects very poorly upon the institution.
At the end of that speech, you Columbia, you nodded to the fact that recessions are inevitable. Fed's job is to kind of forestall them as much as they can. Policymakers' jobs are that. I'm very curious, when you look at the labor market in particular, the rise that we've seen in the unemployment rate, that's the kind of rise we've seen customarily before recessions. How do you assess the risk of there being a recession here in the near term when you look at the labor market, for instance?
So I don't see a recession in the near term, in part because we are adjusting our policy rate by lowering it, which is appropriate. My view, as I've described, is that a variety of shocks that hit the economy, including changes to the population growth rate due to changes in the border policy, have pushed what we call the neutral rate down, and that policy needs to adjust downward to reflect that downward shift in neutral. If we don't adjust policy down, then I think that we do run risks of rising recessions. I don't think it's too late to prevent that, and so I think it's important that we keep on adjusting our policy rate down. But at the moment, it's not my base case, in part because I think that we ultimately will end up continuing to adjust interest rates down.
That was the Fed Governor Stephen Miran there, and we'll have more ahead on the Asia trade. This is Bloomberg. Chinese property developer Vanke has secured last-minute support from creditors to extend a bond grace period, a reprieve that helps it avoid default, at least for now. Let's bring in our China correspondent, Min Lo in Hong Kong. So certainly this is something that would be, yes, a huge win, I guess, for the Chinese company.
Temporary win because it got this extension of another 30 trading days for the grace period. So we will be revisiting this issue again in end January to see whether or not Vanke is truly in the clear, because it has this additional 30 days to pay up. But if not, it could be in default. And the company has failed to garner enough votes yesterday to defer the principal payment of a bond due in early December by 12 months. It needs 90% of the vote. It got only 20%. So we'll see what happens a month from now. But as you can see, it's not just the bond that is under discussion now. There are a few other bonds that are due in the next 6 months or so. They have another bond due December 28, 3.7 billion yuan. And the company has also asked for a deferment on that. So it does seem to have quite a bit of debt on its hands, and it really needs the cash flow to pay up.
So we'll revisit this in a month. But in the meantime, talk to us about the contours, the considerations for bondholders.
Yeah, I think the first time Vanke had asked bondholders for the deferment, it was a very, very bad proposal because it didn't come with any upfront payments or installments. The second time they asked for it, they offered to pay the interest by this Monday, by yesterday. And then they offered to provide some credit enhancements, but still not enough to gather enough support. And that puts Vanke on danger zone for a potential default, because one of the considerations is that it does have many other important creditors to answer to, including Shenzhen Metro, the state-owned shareholder, which also provided I think about 30 billion yuan in unsecured loans. Also, the big banks also extended quite a bit of loan to this company as well. So these other big creditors will likely be also using the time to try to pick off some of the prized assets from the company. Already we had seen Shenzhen Metro, for example, retroactively asking Vanke to pledge some of its assets to some unsecured loans they have extended. So the longer that this drags on, it could leave bondholders with less assets to lay claim to. So some are saying that perhaps it is better to speed things up and to call a default as soon as possible.
Min, thank you so much. Our Bloomberg China correspondent, Min Lo. Let's take a look at how commodities are faring against the backdrop of that stock market rally. We're also seeing gold, silver rallying, and the considerations related to a Fed that is, in the most parts, likely to continue with its cutting and easing. We are seeing it still quite firm on the prices of these precious metals. In terms of oil, it earlier held a 4-day gain. And of course, this is with Venezuela in the background. We are seeing that move off a little. It's interesting to see, despite where the underpinning commodities are, that the likes of silver, gold miners are losing some ground in Australia. We have more ahead on the Asia trade. This is Bloomberg. Bank of America CEO Brian Moynihan says the U.S. economy will be strong next year, due in part to companies ramping up their AI investments. He spoke to Bloomberg about the new technology's growing economic benefits.
The AI investment's been building during the year and is probably a bigger contributor next year and the years beyond. And so if you look at the data center build out, which is one of the ways it evidences itself, that's a big deal. If you look at customer or client spending, like us spending on AI, that's higher than it was last year. But frankly, overall spending levels are shifting towards that, not necessarily growing at a mid-single digit rate type of number. So I think that's part why the reason we feel constructive for next year. We think AI spending continues. We think there's benefits to the American taxpayer from tax rebates, lower taxes due to the tax bill going through and being effective for next year. And we think the expensing and other bonuses for businesses are good. So all that leads to our confidence that we go from basically a 2% type of growth level this year, plus or minus up to 2.4%, which is all due to that. And AI is kicking in more and more. And so it's not all attributable to AI, but that's having a marginal impact that's pretty strong.
So much of the American economy is supported by the consumer. And you at Bank of America have a really powerful viewpoint into the American consumer. How's the American consumer doing? Because it has been very strong. There have been some people saying it's starting to slow down.
You have to step back. We look at American consumers, 70 million consumers, putting $4.5 trillion plus into the American economy every year. And we've tracked the way that goes in the American economy for many years. And so in the third quarter, it was up about 5% over last year. As we look at the fourth quarter here so far in October, November, I'd say it in the 4.5%, which is very consistent with a very solid growing economy. In the end of the day, it's going to work against wage growth. And we see in the underlying consumers we have wage growth, i.e. their paychecks are going up. And so the labor market's flattened out a little bit in terms of job growth and things like that. It's normalizing in terms of unemployment, but you still see underlying wage growth. So the American consumer spending at 4% more November this year versus November last year is a very solid backdrop. The credit quality of the American consumer is strong. And then you hear a lot about this discussion about different rates of growth among different income terciles or thirds. So if we look at the bottom third, middle third, and top third of American income people in the Bank of America customer base, we do see differences, i.e. the higher income and middle income are growing faster. But even the lower income third is still growing, and that's all good. And that means, why is that true? Companies are employing people, they're paying people. Now the labor market's got a little soft, and as we look forward at 4.5, 4.6 unemployment, that is gotten worse, so to speak, than it was at the beginning of the year. But frankly, this goes back to the normalization question. If you look at the 10-year average unemployment, the 20-year, the 30-year, or 40-year, it's 5% and 6%, as you go back through time. And so a 4.5 to 4.6 unemployment rate is a very strong relative unemployment rate. It's just a lot of the years it's been below 4.5% has actually been in the last 10 years. So people are very used to numbers now, which were part of the tightness in labor in the 2017, 18, 19 era. Then you had the pandemic and it retightened. And so it's normalizing, but we feel good about all that, and the consumer's in pretty good shape.
That was the Bank of America CEO Brian Moynihan on Bloomberg's Wall Street Week with David Weston. And let's stick with that conversation on AI, because I think that, yes, there's a conversation that brings it a lot closer to home, especially for you, Avril. But we do have the subject of our big take today is on a company called Megaspeed International. Now, many people would be very unfamiliar with Megaspeed International, but it's actually the biggest buyer of NVIDIA hardware in the Southeast Asian region. So it was only formed back in 2022 or 2023, but through November of this year, it actually acquired $4.6 billion of NVIDIA chips, at least, or near about 140,000 NVIDIA graphics GPUs. And the big question is, where is that technology actually going?
Yeah, I guess that's the focus of this Bloomberg piece, and how this Southeast Asian buyer of NVIDIA's chips, to your point, is in the midst of a chip smuggling probe. So we know how Singapore authorities are looking into this. I think a Malaysian side has been approached as well to find out where we are on this conversation, these investigations. Of course, at stake, this is something that could shape U.S. policy more broadly, especially when it comes to export controls, especially given how NVIDIA has maintained that there's no chip diversion ongoing.
Yeah, exactly. And I think just looking at the technology of that as well, because more than half of the chips that are in the Megaspeed International lineup are from the current generation Blackwell series, which is a series that Chinese companies definitely shouldn't be getting any sort of access to, at least according to the Trump administration rules. But let's leave that there, and do encourage you to read it, of course, in the terminal on full. But the latest on the corporate front as well, because Alphabet shares close higher. That's after the company said it's buying clean energy developer Intersect Power for $4.75 billion in cash, plus existing debt. The move will allow Alphabet to expand its AI data center footprint. Aging US grids are struggling to meet power demand that's booming for the first time in decades, thanks in part to AI. JP Morgan is said to be considering offering cryptocurrency trading to its institutional clients. Bloomberg's learned the bank is assessing what products and services it could offer to expand its footprint in crypto. And Novo Nordisk jumped in late trade. That's after it secured FDA approval for a pill version of its weight loss shot, Wegovy. The pill is expected to launch in the US in early January. It's a crucial product for its strategy to take on Eli Lilly, which has said its own oral obesity drug could be approved by March. You're seeing, again, that reaction in late trade there. Novo Nordisk up nearly 10%. More ahead. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens, and this is following on from a pretty solid Wall Street session where we saw stocks rising. And even when it comes to treasuries, even though yields still seem a little stuck for the moment, the expectation in treasury options tells you that it is of perhaps 4% on the 10-year within a matter of weeks. That seems to be the expectation, the positioning in markets. For the moment, you're seeing futures pointing to maybe another flat open. Given the geopolitical backdrop, we have been seeing precious metals doing really well. The question is the extent in which gold can outperform, given how it has been trailing the likes of silver. Even platinum seems to be playing that catch-up compared to the yellow metal. Now, in terms of the Japan Open, take a look at where we are on the Nikkei at the early goings. The handover from Wall Street not really seeping through into the Japanese session. Of course, we did get these comments from the Japanese finance minister in an exclusive interview with our colleagues, talking about how they are ready to take these bold steps in the FX market if required. And that helped dollar yen to peel away from the 157 handle. So you are seeing it maybe coming down a little, but for there to be more impetus, I think the consensus is that there seems to be not enough of a hawkish signaling from the BOJ. But in the meantime, let's take a listen to what the Japan Finance Minister Katayama had to say.
今回日銀総裁がその記者会見した3時
The yen's sharp, very short-term movement right as the BOJ governor began his press conference last Friday. that was clearly not in line with fundamentals, but rather speculative. Against such moves, we have made clear that we will take bold action, as stated in the Japan-U.S. Finance Minister's joint statement. We have an agreement with the United States that allows us to intervene whenever the yen makes an excessive move. That means we have a free hand.
Joining us now is George Boubouras, Managing Director for Research, Investments and Advisory at Keio Asset Management. George, always good to see you. So we are hearing from the Japan finance chief, but I wonder if I could just get your take first and foremost when it comes to global debt in 2026. Where do you see yields overall, that interplay between perhaps Japan, even Australia, that could be quite hawkish, and what we're seeing out of the U.S.?
Hello, good morning. Thanks for having me on. Broadly, 2026 will be the bond market fatiguing a little bit more on the fiscal pressure with many governments around the world. And each year that it continues, the fiscal pressure creates effectively, all things being equal, higher long bond yields in the nominal sense. And 2026 will be one of the key risks for people to be aware of about how that fiscal concern that we have is replicated. So steeper yield curve is the theme, but longer and long bond yield to be higher, the 10, 15s, the 20s, the 30s, particularly for the UK, parts of Europe and the US, again, as the bond market is getting little or no traction after many, many, many years of government strong fiscal policy, just looking for the out years of how to start clawing that back in.
We saw a bit of those concerns this year, but bonds seem to calm down a little, even on the long end of things. Do you think 2026 is going to be the year where that reckoning comes through?
It can potentially be a year when the reckoning comes through, but it's all okay. So we're talking about a structural sense. We're talking about a structural damage to government balance sheets around the world, and that would be replicated in the structural sense from longer bond yields. But also there'll be pockets of volatility here and there and opportunities to trade it as well. You have the cyclical component of the long structural cycle. But governments around the world, the US is trying, but governments around the world really haven't come back with a out-year, reliable way of saying debt is under control, all things being equal, and bond markets will start questioning it increasingly. So 2026, that will be a risk going forward. And we saw pockets of it with that the French oat market meltdown. We see the gilt market at risk for a mini session of a meltdown as well. Bunds will hold up a little bit. The Mediterranean economies are doing reasonably well on their fiscal side with the help of Brussels here in the out years. But going back to some other countries as well. So again, the US, Japan, long bond yields globally for developed markets, structurally upward pressure in the out years, unless there's a viable alternative plan for bond markets to look at consolidation. And there's no evidence of that at the moment. And that's okay. It's just the way we have to deal with it. So that is one key risk, as well as many others, for 2026 for investors.
How do you see all this influencing FX trends, especially given how the expectation is that the yen continues coming under pressure next year?
Yeah, more pressure for the yen going into the new year. The US dollar weakness in the short term just to pause until around that reporting season or March quarter next year. We don't believe there's a structural US dollar weakness, but it can just track sideways against the euro and yen by the second half of next year. That is a reasonable outcome. But we think the bulk of the alternative precious metal spin-off because of currency risk and fiat currencies for valuation, we think is behind us. We still see upward pressure. We see some rallying can continue for, say, gold as an alternative. But in the main, we think pressure points will always be first and foremost in currency markets. But structural US dollar weakness, we don't see it playing out by the end of next year. The yen is the concern in the short term, but we see some consolidation of that going into January, Feb. But they've got a few policy issues to address, and therefore the volatility opportunities for those that trade is yen, JGBs and Nikkei in that order as policy. That is more policy influence versus other economies around the world.
You say Nikkei. Talk to us about where you think the opportunities lie in terms of positioning for stocks overall.
We are a buyer of Nikkei once we get some look-through on the government policy going through. So the volatility, we're first and foremost into currency markets and then into JGBs. Once we get some consolidation, we want to be buying corporate earnings coming out of Japan, and we believe corporate earnings coming out of Japan, once there's a more certainty on the policy outlook, will be more broad-based, like we're looking for the S&P 500 by the second half of 2026. So that's what we're looking for, buying those earnings more broad-based in the second half of 26, but getting through this bump and some more uncertainty, and the currency market will be absorbing the bulk of that volatility and into JGBs. But looking for broad-based recovery, Nikkei earnings, but looking to participate in that, and we see that benefiting in the second half of calendar 2026.
Where else do you think there lies that opportunity? I mean, it sounds a bit like the tech rattles for the recent past is not so much of a concern for you.
Not at all. The Magnificent Seven, to overgeneralise, has come off its peak. We believe the broad-based EPS, we have an EPS target of 12% for calendar 2026. We believe that's achievable. This is an overgeneralisation, but let's just say 15% of that 12% is AI driven. We need verification of that in the upcoming reporting season. And there is a solid broad-based recovery for corporate earnings in North America, outside of the tech and financials and healthcare. Rallies been quite extensive, mid-cap, small-cap, and we're trying to participate in that as well. So we think that this is a very well structural cycle of double-digit EPS growth for corporate America. We believe the tailwinds are reasonable. They're not going to be hiking rates at the Fed. We think at the top end of the real rate at the moment, there's more scope to create some fiscal stimulus. Earnings are expanding. Seems quite reasonable backdrop to be participating in that, but there is a broad-based recovery underway. Again, the verification in the next quarterly earnings will be how is AI participating in that earnings upside. We believe 15% of that will come from the AI. So we like that. Senior unsecured for fixed income, underweight high yield in the developed market, overgeneralisation. But again, we believe the tight spreads in the high yield don't warrant the risk that you're absorbing. But we like senior unsecured investment grade credit, some MBS in North America. Depends what tranche are in there. But in the main, we are pro-risk going into 2026. And hence the target for S&P 500 around that 7,600, 7,650 with that EPS upgrade.
When it comes to AI, I think you have the likes of the Bank of America chief, Brian Moynihan, agreeing with you in terms of the impact also coming through in the U.S. economy. George, great to chat with you. Thank you so much. And happy holidays. Hope you get a restful end to the year. George Boubouras is Managing Director for Research Investments and Advisory at K2 Asset Management. Now let's take another look at how U.S. Treasuries are faring, because we've spoken about this, how the expectation is for some in the markets that we see lower yields on the 10-year. For the moment, though, it does look a little bit stuck. We are still seeing dollar-yen hovering at that 156.8 level. The moves overnight were in relation slightly through the comments from the Japanese finance chief, Katayama. You are still looking at 206 on the yield on the 10-year in Japan. We have more ahead on the Asia trade. This is Bloomberg. President Trump has warned Venezuela's leader not to challenge the U.S., as he said America would keep the oil seized from a supertanker. But Trump declined to say if he's seeking to oust Nicolas Maduro, despite comments to that effect from members of his cabinet team. Let's get more with Bloomberg managing editor Jill Deeses. So, Jill, We are seeing a sort of escalation between the U.S. and Venezuela the past couple of weeks. What is the end game for the U.S.? How far is the Trump administration likely to go?
Well, look, Avril, I think what's really important is despite, Trump kind of demurring on that question of regime change just, a few moments ago, that is language that we have heard fairly prominently from other members of his cabinet. I think pretty, chiefly Kristi Noem talking about needing to get Maduro out. At this point, what we've really seen, you're seeing this map on your screen right now showing you the locations of where these tankers were intercepted. I mean, this is really kind of the largest military action that the United States has taken the Caribbean in quite some time. So there's obviously an intense amount of pressure that the United States is applying on Venezuela at this point. In terms of ultimate impact on oil markets more broadly, obviously we've seen it tick up, but Venezuela ultimately accounts for about a 1 percentage point or so of, or 1%, of oil production. But it still is obviously a pretty strong measure against Venezuela at this point. And given that we've seen this trend sort of tick upward, despite these most recent comments from Trump, it does seem pretty clear that this is about maximizing pressure on Venezuela right now.
A fraction of global oil production comes from Venezuela, to your point, and most of its production goes to China. What has the reaction to Beijing and all this been?
Yes, well, China yesterday actually at a foreign affairs press conference, this is one of the regular briefings, but they did denounce the United States actions. So obviously, the China really sort of speaking out about this. The one thing that I will point out, though, about China is that despite the fact that they're obviously a major buyer of Venezuelan oil, they do actually have, significant alternatives that they can, go to, including in Russia and the Middle East. So in terms of impact on China, obviously, there's ways that they can sort of get around this. But again, as you're seeing here, you are seeing some fairly strong comments coming out of Beijing in response to the United States' actions in Venezuela.
In terms of strong comments, we've also heard from the commander-in-chief in the U.S. making an announcement on the Golden Fleet, talking about building this new class of warship as well. What are the considerations for the U.S. in all this? What spurred such a move?
Well, the Trump administration throughout this year has been, I think, pretty vocal about its desire for, one, increased military power, but then also for a revival in U.S. shipbuilding. And so the U.S. Navy announcement that you saw today was about this new class of warship. They want to have the first boat ready by 2028. And then they're also really keen on sort of, developing something that feels really smart technologically and then upgrading it. I think this is kind of, again, sort of part of this larger narrative that you're seeing within the Trump administration about bolstering, defense capabilities, and again, also pointing to some of those shipbuilding capabilities. So that's really what you're getting out of this end-of-year announcement from the Navy.
Jill, thank you so much for providing this context. We really appreciate it. Bloomberg Managing Editor Jill Desis. Now, against that backdrop, we are seeing some of these movers in South Korean trade, including the likes of Hanwha Ocean. That's one stock we're keeping track of. We're seeing a bit of that surge, maybe to do with this announcement coming from the Trump administration as well. But overall, markets in South Korea are looking fairly buoyant. On to some other top global headlines we're following. A senior Russian general has been killed after a bomb exploded in his car in Moscow. Vanil Sarvarov was in charge of the operational training department in the Russian general staff. Investigators have opened a murder inquiry and are looking into Ukrainian involvement as a potential theory. Russia's liquefied natural gas exports to China surged to a record in November as buyers shrugged off the risk of Western sanctions. Deliveries more than doubled from a year ago to 1.6 million metric tons. That means Russia is now China's second biggest LNG supplier after Qatar. Cambodia and Thailand have agreed to meet on Wednesday to discuss conditions for a ceasefire. The decision came after foreign ministers from Southeast Asian nations met in Kuala Lumpur. At least 40 people have been killed and 500,000 displaced since hostilities resumed this month, ending a July truce that halted an earlier round of fighting. The U.S. Federal Communications Commission says it'll ban most foreign-made drones and critical components for unmanned aircraft systems. The new rules apply to future imports and sales, not those already in use. The decision comes ahead of a deadline for adding Chinese drone maker DJI technology to the agency's covered entity list. We have more ahead on the Asia trade. This is Bloomberg. It's quite a positive day on Asia stocks for the moment. Actually, a bit of mixed bag, though, if you look under the hood when it comes to tech. Actually, the drivers for the moment are some of these commodities-related stocks. But you are seeing, maybe because of that slight bit of appreciation seeping into the Japanese yen, putting pressure on some of these Japanese-related tech stocks, Tokyo Electron, Advantis among them. But of course, we're also tracking the chip makers in South Korea, Samsung, SK Hynix. And we are hearing from South Korean media that Samsung's high bandwidth memory 4 has posted the highest score in NVIDIA tests. Of course, this is an area of the market where it is facing off fierce rivalry with SK Hynix on, and these are your market leaders as they have been for much of the year, but looks like we could see, as was the case on Wall Street overnight, as that Santa Claus rally seems to be taking hold, the extent in which we might see that reflected in tech names in the Asia Pacific as well. Now, on that note, we have Bank of America CEO Brian Moynihan saying that the U.S. economy will be strong next year, due in part to companies ramping up their AI investments. He spoke to Bloomberg about the new technology's growing economic benefits.
The AI investment's been building during the year and is probably a bigger contributor next year and the years beyond. And so if you look at the data center build out, which is one of the ways it evidences itself, that's a big deal. If you look at customer or client spending, like us spending on AI, that's higher than it was last year. But frankly, overall spending levels are shifting towards that, not necessarily growing at a mid-single digit rate type of number. So I think that's part why the reason we feel constructive for next year. We think AI spending continues. We think there's benefits to the American taxpayer from tax rebates, lower taxes due to the tax bill going through and being effective for next year. And we think the expensing and other bonuses for businesses are good. So all that leads to our confidence that we go from basically a 2% type of growth level this year, plus or minus up to 2.4%, which is all due to that. And AI is kicking in more and more. And so it's not all attributable to AI, but that's having a marginal impact that's pretty strong.
So much of the American economy is supported by the consumer. And you at Bank of America have a really powerful viewpoint into the American consumer. How's the American consumer doing? Because it has been very strong. There have been some people saying it's starting to slow down.
You have to step back. We look at American consumers, 70 million consumers, putting $4.5 trillion plus into the American economy every year. And we've tracked the way that goes in the American economy for many years. And so in the third quarter, it was up about 5% over last year. As we look at the fourth quarter here so far in October, November, I'd say it in the 4.5%, which is very consistent with a very solid growing economy. In the end of the day, it's going to work against wage growth. And we see in the underlying consumers we have wage growth, i.e. their paychecks are going up. And so the labor market's flattened out a little bit in terms of job growth and things like that. It's normalizing in terms of unemployment, but you still see underlying wage growth. So the American consumer spending at 4% more November this year versus November last year is a very solid backdrop. The credit quality of the American consumer is strong. And then you hear a lot about this discussion about different rates of growth among different income terciles or thirds. So if we look at the bottom third, middle third, and top third of American income people in the Bank of America customer base, we do see differences, i.e. the higher income and middle income are growing faster, but even the lower income third is still growing, and that's all good. And that means, why is that true? Companies are employing people, they're paying people. Now the labor market's got a little soft, and as we look forward at 4.5, 4.6 unemployment, that is gotten worse, so to speak, than it was at the beginning of the year. But frankly, this goes back to the normalization question. If you look at the 10-year average unemployment, the 20-year, the 30-year, 40-year, it's 5 and 6%, as you go back through time. And so a 4.5 to 4.6 unemployment rate is a very strong relative unemployment rate. It's just a lot of the years it's been below 4.5% has actually been in the last 10 years. So people are very used to numbers now, which were part of the tightness in labor in the 2017, 18, 19 era. Then you had the pandemic and it retightened. And so it's normalizing, but we feel good about all that, and the consumer's in pretty good shape.
Bank of America CEO Brian Moynihan on Bloomberg's Wall Street Week with David Weston. Now, some other top corporate stories we're tracking. Novo Nordisk jumped in late trade after it secured FDA approval for a pill version of its weight loss shot Wegovy. The pill is expected to launch in the U.S. in early January. The product is crucial for Novo's strategy to take on Eli Lilly, which has said its own oral obesity drug could be approved by March. Alphabet shares closed higher after the company said it's buying clean energy developer Intersect Power for $4.75 billion in cash plus existing debt. The move will allow Alphabet to expand its AI data center footprint. Aging U.S. grids are struggling to meet power demand that's booming for the first time in decades, thanks in part to artificial intelligence. JP Morgan is said to be considering offering cryptocurrency trading to its institutional clients. Bloomberg has learned the bank is assessing what products and services it could offer to expand its footprint in crypto. The move is a sign of how banks have warmed up to digital assets since a crypto-friendly administration took office. JP Morgan Asset Management is launching a private fund designed to maximize after-tax returns by generating losses. A source says the tax-smart disciplined equity long-short strategy takes bullish positions in a basket of stocks while also betting against certain companies. So-called tax-aware investing is becoming one of the hottest trends in wealth management as clients seek to reduce their tax bills. Coming up, the yen in focus as Finance Minister Satsuki Katayama tells Bloomberg exclusively that Japan has a free hand to act against speculative currency moves. Hear more from our exclusive interview next. This is Bloomberg. Some breaking crossing the terminal with the release of the RBA's minutes of its December meeting. And of course, this was the one where we heard a bit of a hawkish tilt from the Australian Central Bank. And based on these minutes, we are hearing that they discussed the circumstances in which a rate rise might be needed next year, and that the recent data suggested risks to the inflation are tilted to the upside. They also say they'll stay attentive to data, assess the evolving outlook. It is not clear, they say, whether current financial conditions are restrictive enough. And also interesting how they acknowledge the full impact of policy easing this year is yet to be seen. We are seeing, of course, that consolidation on Aussie against the greenback. And in terms of stocks, miners in general have been doing quite well down under. Let's take a look at how Japan is faring. It's about the yen, following the comments from the Japanese finance chief, following on, of course, from a BOJ that to market participants was not hawkish enough in terms of the messaging, the follow-through on the subsequent rate hikes that need to come to kind of quell the pressure we've been seeing on the local currency. We've been hearing from the Japanese finance minister issuing her strongest warning yet to currency speculators, telling Bloomberg that officials have a free hand to take action. Satsuki Katayama spoke to us exclusively in Tokyo.
為替の状況っていうのは必ずしも
Foreign exchange markets don't move only on interest rates or rate differentials. Especially toward the end of the year, around Christmas, trading tends to get thin, and many factors can drive the yen's moves. But the yen's sharp, very short-term movement right as the BOJ governor began his press conference last Friday, that was clearly not in line with fundamentals, but rather speculative. Against such moves, we have made clear that we will take bold action, as stated in the Japan-U.S. finance minister's joint statement.
Now that the Bank of Japan has moved to raise interest rates, the next focus is clearly on whether the government will step in with foreign exchange intervention. How do you see it?
We have
an agreement with the United States that allows us to intervene whenever the yen makes an excessive move. That means we have a free hand.
In the past, a finance official has called a 10-yen move in a little more than a month excessive. So what kind of time frame and magnitude would you consider a sharp or disorderly move? Is there any benchmark you use to assess that?
I can't say definitively whether there's a benchmark or not. I worked closely with currency chiefs during my 20 years at the finance ministry, and I've stayed in close touch with many of those who came after I left. Each situation is different, so it would be wrong to expect the same pattern every time.
Trading tends to thin out around the year-end and New Year period. Is it fair to say that the authorities are fully prepared to respond?
We're always ready to act. That goes without saying.
When it comes to a question of a certain degree of fiscal discipline, there are various ways to interpret that. For example, how much the government relies on bond issuance or how much JGBs it'll issue. Could you share a bit more on how you're thinking about these points?
I
can't give you specific numbers, but even after the supplementary budget was passed, we made it clear that the total amount of government bond issuance, which, after all, is what puts pressure on the market, did not increase. At this time, we're talking about the initial budget for fiscal year 2026. We're confident that it won't be something that places an undue burden on the market either.
There are concerns in the market that Japan's fiscal position may be deteriorating. What message would you like to send in response to those concerns?
By switching to active fiscal policy, we knew before we started that in the first fiscal year, some of the finance numbers would deteriorate. But that isn't the problem. We've spent 10, 20, even 30 years in a situation where economic growth barely picked up no matter what we did. There's no point in just doing the same things as before. We need to make a decisive shift, to concentrate resources and boost our growth potential. I believe we'll see a strong pickup in investment next year. And if you look at projected tax revenues for next year and the year after, I think what looks like fiscal deterioration now will prove to be only temporary.
Japanese Finance Minister Satsuki Katayama speaking exclusively with Bloomberg's Takashi Umekawa in Tokyo. Joining us now is David Finnerty, Bloomberg FX and rates strategist. David, I know you've been tracking very closely the moves in the yen. What have you been hearing among FX traders and the idea that whatever we've been hearing from Japanese authorities so far is just not enough to arrest the slide?
It's not enough to arrest the slide at the moment because people didn't get what they wanted out of Governor Ueda last Friday in the BOJ decision. He was very vague about where the terminal rate would be. He was very vague about the next hike. So that sort of disappointed market expectations. Having said that, when you start getting around the 158 to 160 area, people are cognizant that there's a risk of intervention. And obviously with Katayama's comments coming out, then that followed the vice chairs, who also is the top currency official. He came out on Monday saying, I'm worried about this one-sided moves. So the market is a bit jittery, shall we say. Having said that, it is low liquidity, so some of the moves can be a bit exacerbated. I think some of yesterday's moves for the yen was aided by broad dollar weakness. If you look across all currencies, the dollar actually weakened more against the Aussie dollar, more against sterling, more against the Kiwi. So yes, there was a yen move, but really it was in the picture of a bigger weaker dollar story, again, in low liquidity going to year end when people are beginning to square up positions.
Yeah, so you talk about this interplay of FX. We are seeing that Aussie move, maybe the expectations of the RBA. What are rates traders expecting from the Australian Central Bank?
Certainly, some people are expecting that the February meeting could be live. Now, the markets aren't pricing, we're basically pricing 2 potential rate hikes by the RBA next year, basically one by summer, one by the year end. But certainly economists are going, look, February could be live. And I think the key thing for that is something that came out in the minutes, the inflation. And you do have the fourth quarter inflation data coming out towards the end of January, which will be just prior to the RBA's next meeting on the beginning of February. So if that comes in higher than expected, you could certainly expect the expectations for a rate hike to be brought forward, and that idea of February being a live meeting to certainly pick up.
Does this mean weakness in the dollar is more or less a done deal in 2026, given all these other central banks that appear more hawkish than the Fed?
I think that is a debate that's ongoing at the moment. The market's already priced in 2 quarter-point rate cuts for the Fed. So if those are dialed back for whatever reason, say inflation comes in a bit higher than expected or growth is stronger than expected, then that would be obviously dollar supportive. So while, yes, there is a divergence in policies, you have to remember a lot of that's already been priced in. So therefore, to get a change from that, you need an additional differentiation, shall we say. So I think what goes on while the US growth will be actually quite a key factor. If you remember, the tax cuts extension basically comes into play next year. So US growth, if it does pick up, you could see maybe that dollar story of weakness may not be quite as profound as it was this year. But certainly there's a debate going on in the market is like, where does dollar go? It's very mixed at the moment. I think that's why you're seeing this choppy trade that you're seeing.
Among Treasury traders, options, we are seeing that bet that we could see a 4% handle within weeks. What do you think it'll take for us to get there, given how, the Fed meet is still a little while from here?
Yeah, I think because the Fed meeting is still a few weeks away, obviously data really becomes key. I mean, as I said, in the next 2 weeks or basically through the year, you do have low liquidity, so you could see exacerbated moves. But then really, I think you go to US payrolls at the start of the month. I think that becomes it's not January, becomes exceedingly important. The most recent payroll data, the market's like, how accurate was it, given obviously the government shutdown? I think the perception is the January data, which will be for December, will be a lot cleaner image of what is going on in the US economy, and that I think will be a big focus for the markets in terms of driving rates.
There's something to watch. David, thank you so much. Much appreciated. Bloomberg FX and rate strategist David Finnerty. Now, we are seeing, interestingly, in commodities, the rally extending in precious metals, particularly gold and silver. And this is despite relatively elevated yields. So pretty remarkable to see this dynamic emerging, tracking oil prices as well. We see a bit of that pullback from the recent spikes following the tensions with Venezuela and the US. And we are, of course, tracking copper prices, given the supply dynamics and, of course, the energy transition. That's something that has also propelled the red metal to records. Metals and mining reporter Martin Ritchie joins us now for more on the outlook. First, let's talk, Martin, I guess, on precious metals. We are seeing, interestingly, how gold's outperformance, it's kind of being overtaken by silver, by platinum. Talk to us about the dynamics into the first half of next year and the odds that gold kind of takes top spot again.
Yeah, I mean, first of all, just to take a step back to look at gold over the course of this year, there's been 50 days this year where gold has set a new record. So it's really been a very powerful and steady rise throughout this year. We're now within sight of $4,500 an ounce. And there's not that many people, I would say, who see gold fading into next year. There's still a lot of bulls around for some of the same reasons that's driven gold this year. We've obviously had a lot of geopolitical tensions, we've had monetary easing, and we've had sort of growing doubts about the sovereign bonds and currencies worldwide. And as your previous speaker was just mentioning, we had the weaker dollar as well. So while the dollar's course may be a little bit uncertain, I think some of the more structural changes that are driving gold, these kind of geopolitical tensions and the sort of fear that the existing kind of global financial architecture is coming under changes over the next coming years, I think that's going to remain. And then if you look at who's buying gold, central banks and investors into gold exchange traded funds. Central banks have been really important in the past 2 years in driving up gold prices. and don't think that they're going to disappear anytime soon. And if we look at private investors, their holdings in gold are still relatively low versus everything else. And any small move by major investors into gold, into precious, is going to keep up this momentum. So it is difficult, I think, just looking at what people talk about, to see where this weakness in gold is going to come from next year.
Martin, to your point about this being a bit of a crowded trade and hard-pressed to find anyone that I think is not bullish on gold, I guess also worth unpacking what we're seeing in other metals, including copper. The dynamics there, of course, are different. But what are you seeing in terms of the supply constraints on the red metal and how that is going to be a driver in 2026?
Yeah, I think specifically on copper, quite a different picture actually. Copper's obviously got constrained supply. That's the kind of the narrative in which the bulls in copper have built it up over the years. But some of the trade this year has been very specific about, and we call it the US tariff trade, essentially. Donald Trump has to make a decision, is expected to make a decision in the middle of next year about tariffs on refined copper into the US that might come into force at the beginning of the following year. Traders are rushing lots and lots of metal from all around the rest of the world into the US to get it there before any tariffs, and that's tightening the market in the rest of the world. And so that's what's kind of driving up copper in the past few months, in addition to some of the mine disruptions and so on. So that looks like more of a temporary trade, more of a kind of specific tariff trade than all the sort of structural factors that are driving up gold prices.
Martin, thank you. Our metals and mining reporter, Martin Ritchie, with the latest on metals. More ahead on the Asia trade. This is Bloomberg. The Australian state of New South Wales intends to pass some of the toughest gun control laws in the country, following last week's terrorist attack at Sydney's Bondi Beach. Other states are expected to follow suit, while the federal government plans to launch a buyback of weapons. Bloomberg's Paul Allen joins us now with more. So, Paul, first off, how much public support is there for such measures?
Yeah, the support is fairly overwhelming, Avril. There was just a poll in one of the local media outlets today, a resolve poll of 1,000 people, found 74% support for further tightening of gun laws, so that's fairly comprehensive. The New South Wales government is proposing a number of changes, including limits to the number of firearms an individual can own. The dead gunman, Sajid Akram, owned 6. It would also limit open-ended licensing and make a gun licence a requirement would be to be an Australian citizen. Now, the expectation is this gets passed before Christmas, so in a couple of days. It did clear its first hurdle in the New South Wales Parliament last night, and as you mentioned there, other states and territories are seen following suit as well. On the federal level, Anthony Albanese, the Prime Minister, last week announced a buyback of firearms, the biggest since the Port Arthur massacre back in 1996. And that incident sparked the initial toughening of gun laws back then, and that's been credited with preventing events like you see on your screen there for pretty much the past 40 years. But one of the questions doing the rounds of those opposed to this tightening of gun laws is, well, were the existing laws adequate? Now, with that in mind, we want to get to our next guest now, Samara McPhedran, a Principal Research Fellow at Griffith University, who focuses on firearm-related injury and gun policy. Samara, thanks a lot for joining us. And in the shakedown after last Sunday's terrible events, a number of factors have emerged. As I mentioned, the gunman Sajid Akram had 6 weapons. He owned them legally, but 3 of them he bought on the same same day, and 2 of them were identical. That's not meant to be legal. And he also had a firearms license, which took 3 years to get, which he probably shouldn't have, considering his son lived with him, and his son was the subject of a spy agency investigation. So that's a long way of asking, were the existing laws enough? Was it really a problem of enforcement?
Well, more and more, as more facts come to light, it does appear that there's been a catastrophic failure of enforcement with the existing laws. The laws that have been in place in New South Wales for many years on paper were more than sufficient to have covered this situation and should have prevented that individual from obtaining a licence. Now, the fact that there are so many irregularities in the licensing process, the fact that it took an abnormally long amount of time between the application in 2020 and when it was issued in 2023, all of this raises some very, very serious questions that so far the New South Wales government isn't answering. And certainly this does appear to indicate that the existing laws were sufficient, but that we do need to understand what went wrong with the administration and enforcement of those.
Why is it then that you think the national conversation at the moment is about the toughening of gun laws rather than more effective enforcement of the existing laws?
That's a great question. And unfortunately, when events like this occur, we seem to fall back into a very predictable script where politicians make very quick political announcements. Those announcements get headlines, and they deflect attention away from bigger problems and from some very serious social issues in this particular instance. So although this is a very typical response by politicians, it is very much about politics and deflection rather than calmly and carefully going through the facts and working out exactly what went wrong. Unfortunately, we've seen this type of response over and over again. And once again, here we are having this same conversation and going down this same path that we've gone down so many times before.
What needs to change, and what are you seeing in terms of what's at the heart of these social issues that are prompting lethal violence?
What we've seen over so many years and across the political spectrum, this isn't a left or right issue, but for such a long time, we've seen politicians dividing us. We've seen the rise of identity politics, where for short-term political gain, politicians have set us against each other. We've become such a divided country. We're divided along the lines of race, religion, culture, ethnicity, so many different things. And that's fostered an environment of perpetual hostility and grievance. And where those things fester, we do see violence, whether that's gun violence or other types of violence. The underlying factors are often the same. And so we really need to start looking at how we engage with each other, how we can respectfully disagree with each other, and how we conduct public debate in a way that doesn't further inflame division in society.
Samara, we've only got about a minute left, but I'm just wondering very quickly, is there still a case for tougher gun laws? Because nobody needs 6 weapons, and should anybody hold a licence indefinitely?
The licences already are time limited, so there's no such thing as an indefinite licence. As to the rest, ultimately, if we're serious about reducing firearm violence, let alone other forms of violence, we actually need to look at the evidence and take a close look at what works, rather than just grabbing things that sound good or may make people feel safe. We need to really address the problems here, not look for quick fix solutions.
It sparked a deeper national conversation, a pertinent one. Samara, thank you so much for your insights today. Samara McPhedran is Principal Research Fellow at Griffith University, and thank you as well to our very own Paul Allen. We have more ahead on Australia Ahead every Tuesday at 11:40 a.m. if you're watching in Sydney, 8:40 a.m. in Hong Kong. More ahead on the Asia trade. This is Bloomberg.